What does it take for you to get qualified to purchase a home? That's what we're going to be talking about in this episode. And everything is going to be around 3 different categories of employment: salary, hourly, and self-employed. You're going to fall into one of these 3 categories, and I'm going to tell you what it's going to take for you to be able to get qualified, as well as how a lender is going to view your type of employment when it comes to you trying to purchase that home. So we're going to start off with the easiest first. When it comes to salary employment, these are individuals that know exactly what they're going to get paid every single paycheck because they're paid salary, so the amount does not change. They get paid the same amount every week, every 2 weeks, every month, depending upon how frequently they get paid, but it's the same amount every single paycheck, and they know what they're going to get by the end of the year. This is the type of employment that lenders love. They place the highest value on salary employment because it is the most stable form of employment. You're getting the same whether you work 30 hours or 40 hours or 35 hours, whatever, you get the same amount of money each paycheck. And so with that, lenders are typically going to need your W-2s. They're going to need your last 30 days of pay stubs. They're going to want to see bank statements for assets. But again, having that salary employment is going to be something that lenders are going to place a high value on, which is going to help your profile look even stronger. Now, after salary, there's hourly employment. Hourly employment, the same requirements are needed in terms of you need to provide your last 2 years of W-2s, last 30 days of pay stubs, 2 months of bank statements. However, lenders are going to look more deeply into your pay stubs because they want to see how many hours per week you work on average. Because again, when you're hourly employee and not salary, how much your check is that you get paid can vary from paycheck to paycheck, depending upon whether you work 30 hours this week, 40 hours the next week, 37 the next week. So they're going to want to see how many hours do you work on average in each of your paychecks. And that's the number that they're going to use to determine what your income is. But then separate from your base pay, there's also overtime. Maybe you work a job where you get paid overtime. Well, now a lender is going to need to look at a 2-year history of overtime to determine whether or not they can include that overtime in your income. So for your hourly pay, you might be able to, a lender might look at your last 30 days of pay stubs. They might go back a little bit further if needed to see what that average is. But if you're wanting to include overtime that you get paid in your income, you will have needed to receive that income or that overtime for at least 2 years in order for a lender to be able to count that into your income calculation, because they want to see that there's a stability or that there's a routine with you consistently receiving overtime for your type of employment. It's not something that you just received this year, but you haven't received it in the past few years. So 2 years is what they're going to want to see as a history of overtime. They're going to average out those 2 years to see how much they can actually calculate for overtime. And then base pay, they're going to look at that as well. And same thing if you get bonus pay or something like that, they're going to want to see a 2-year history of you having received bonuses, and they want to see a likelihood of it continuing in the future as well with your employment. So that's how they look at hourly pay. Again, salary, they're placing the highest value on. Hourly is a little bit less than salary, still a stable form of employment, but they're going to dig into those pay stubs to really see how many hours per week you work on average. And if there's other types of pay, they're going to want to calculate that in there. Now we're going to get into self-employed. When it comes to a self-employed borrower, this is the most scrutinized form of employment. It is not impossible to purchase a home as a self-employed borrower. So I just want to put that out there. There are many people that have done it, many people today that are continuing to be able to purchase homes as a self-employed borrower. However, it is going to be scrutinized because when you're self-employed, you're not receiving a W-2, you're not receiving pay stubs. So a mortgage loan officer is going to dig into your tax records, and they're going to need to see the last 2 years of tax returns because they want to see what you have filed on your tax returns in terms of what you have claimed to have made, because that's what you pay taxes on. There's something else in addition to that. It's not just what you have claimed on your tax returns. A mortgage loan officer is going to subtract out whatever amount you have written off as on your taxes as a write-off or a deduction. So for example, let's say that you made $100,000 in self-employment income, but then you wrote off $60,000 in expenses. That mortgage lender is going to have to deduct $60,000 from that $100,000 that you made, meaning that they're only looking at $40,000 to be able to qualify you on. That's part of the downfall with the self-employment income. And I hate to use the term downfall, but it's one of the things that you need to be aware of when it comes to trying to qualify as a self-employed home buyer, is that a mortgage lender is going to need to look at those last 2 years of tax returns, but they're also going to be subtracting out those write-offs. Part of what a lot of self-employed individuals do is that they have a lot of tax write-offs because that's part of how you save from having to pay the government so much of your hard-earned money. And so with that, there are some programs, I'm gonna get into that in just a moment, to help avoid that. There's pluses and minuses to everything, but just know that if you're trying to qualify via the traditional means, an FHA loan, a conventional loan, VA loan, USDA loan, they're going to need to see those last 2 years of tax returns, and then they're also going to deduct whatever tax write-offs you've had from your income, and what's left over is what you can actually qualify. A lot of people think that, oh, so that means that either I have little money to qualify on, or I can't write off anything, meaning that I have to pay more in taxes just to be able to use more of my income to qualify for a home. That's the double-edged sword part of the self-employed thing. It's like you either can't write off everything in taxes, or else you're not going to have enough to qualify, or you write off very little to nothing in taxes, but now you're paying a whole lot more money to the government in taxes just so you can have more money to be able to qualify. Pick your poison, if you will. But if you're a self-employed borrower, another option that you have is what's called a bank statement loan. A bank statement loan is a type of loan that is considered a non-QM or non-qualified mortgage, which means that it doesn't fall under the traditional lending guidelines of an FHA or a conventional loan. So with a bank statement loan, a mortgage lender looks at your last 12 to 24 months of bank statements. If you provide 24 months, it's possible you can get a better interest rate. But you provide your last 12 to 24 months of bank statements. A loan officer is going to look at that and determine, just based on the income that shows up on your bank statements, how much you can actually qualify for. They're going to utilize that to determine your income. Now, with bank statement loans, oftentimes you are going to pay a higher interest rate and a higher down payment. Again, they are not using the traditional means of tax returns to be able to qualify you. One rule of thumb that you should note is that the more documentation that you provide to be able to get approved for a home loan, generally your down payment cost can be less and your interest rate will likely be a little bit better than if you were to go a non-qualified route, in which case you don't have to provide as much documentation. So just keep that in mind as well. But when you're doing that bank statement loan, many times you're going to have a higher down payment and you're going to be paying a higher interest rate, in addition to potentially paying higher closing costs as well. So with the down payment, oftentimes at a minimum, you will be paying at least a 10% down payment, and that's if you have great credit. If your credit's not great, you could be paying 15% or higher, but at a minimum, you're going to be paying at least a 10% down payment. So do the math. If you're purchasing a $400,000 home, that's $40,000 that you're going to need just for your down payment, not including closing costs. So with that, you're also going to have, like I said, an increased interest rate. So with an FHA loan and a conventional loan, your interest rates are more than likely going to be lower than what they will be if you were to do a bank statement loan or any non-qualified mortgage loan, because it's a riskier loan. We as in lenders, mortgage loan officers, they're only looking at your bank statements to make a determination on your income. They're not looking at your tax returns. They're not looking at pay stubs. They're not looking at W-2s. So with that limited information, there's an increased risk associated with that. And so because of that, your interest rate is going to be higher to help compensate for that. But like I also said, that third thing, increased down payment, increased interest rates, the third thing being increased closing costs. A lot of these bank statement loans are brokered through lenders that specialize in doing those bank statement loans. And because of that, there's a broker fee that's often associated with doing these loans. Sometimes it could be 2%, it could be 2.5% of the loan amount that ends up getting paid in a broker's fee. So if you have a $400,000 loan amount, well, 2% of that is going to be $8,000 that you would have to pay in a broker fee. So just keep that in mind, when you're thinking about whether you want to go the bank statement route or whether you want to supply all the documentation to get a traditional home loan or a traditional mortgage loan, because there are additional costs associated with it. Now, one other thing that I did want to point out, some people are working second jobs. And if you are one of those individuals who works a second job and you're wondering, well, can I utilize the employment or the income from that second job to be able to count towards me being able to get approved for a home loan? The answer is, it depends. How long have you been working that second job? According to traditional underwriting guidelines, you need to have been working that second job for 2 years in order for the income to be counted. And it's not just the second job that you need to have been working for 2 years. You need to have been working 2 jobs simultaneously for a 2-year period in order to count the income from both jobs. That is how that works. So if you picked up a second job a year ago and you got your primary job that you've been working, let's say for the last 3 years, you're not going to be able to count the income for both of those employments. You're not going to be able to count the income from both of them to be able to qualify for a mortgage, because the second job you've only been working for a year. And so even though you've been working both of them simultaneously for 1 year, you need that 2-year history of having worked at least 2 jobs for at least 2 years in order to count the income for that and be able to benefit from 2 incomes to qualify for the mortgage. So that's one of the things with working those 2 jobs. Now, if you do have a situation in which you've been working 2 jobs for at least 2 years, then you can utilize the income from both of those jobs to be able to qualify for a home loan. And the same criteria that I just explained with the self-employment and the salary and the hourly jobs is going to apply to each of these jobs. If one of these jobs is a self-employment job and the other job is a salary job, well, all of the criteria that we're going to need for the self-employment job, your tax returns and everything, your bank statements, is going to apply for that self-employment job. And then for your salary job, your W-2s, your pay stubs, that's still going to be needed for that as well. So again, all of this documentation is going to be needed in order to help you get qualified under a traditional loan. Your income is going to fall into one of those 3 categories. If you're 1099, 1099 is treated as self-employment when it comes to you purchasing a home. So if you're an independent contractor, a real estate agent, or you do construction work on a contract basis, whatever it might be, if you get paid via 1099, a mortgage lender is going to look at that as self-employed income, and thereby you are going to need to provide your tax returns as well as your bank statements so that they can see how much income you actually claimed on your tax returns, which is what they can utilize to qualify you for the mortgage, minus any of those tax write-offs that you claimed on that on your tax returns as well. You're going to have to deduct all of those write-offs and then take what's left over to be able to apply to you being able to purchase that home or qualify for that home loan. So there are some programs out there as well that will allow you to submit 1099s. Again, these are non-qualified mortgage programs. So higher down payment, higher interest rate, higher closing costs. Keep that in mind. Anytime you veer away from an FHA or conventional or VA or a USDA loan, anytime you veer away from those loans, those 4 types of loans, plan on having a higher down payment, a higher interest rate, and higher closing costs as well. Just plan on that. So if you want to have lower of all those things, then submit the documentation necessary to be able to get approved under the FHA, VA, USDA, or a conventional loan. So that's what I have for you. And hopefully this has been beneficial. Make sure you give me a thumbs up if this has been information that is useful to you. I'm going to continue to put out some information that hopefully will help you be able to move closer towards becoming a homeowner, and also give you some tips as well as some ways that you can save money on mortgage payments, save thousands and tens of thousands a month on, not a month, but thousands a month or tens of thousands of dollars a year on purchasing a home when it comes to financing. So some little tricks and tips. You can find all of those tricks and tips on Tuesdays. It's a lot of T's. Tricks, tips on Tuesdays. I do home finance hacks every Tuesday, 7 p.m. Make sure you're there. Join live because there is going to be a lot of information that I put out live. I do release the recordings as well. So if you happen to miss it, you can go back and watch the recording as well. But that's where I put out so much information on how you can literally save thousands, how you can be able to purchase a home without putting any money down at all. That's actually what I talked about this past Tuesday, was different ways that you can purchase a home without any of your money being utilized for the down payment and closing costs. So that was huge. But I also, in previous home finance hacks, in previous Tuesdays for home finance hacks, I've discussed ways that you can literally save thousands and tens of thousands of dollars in just how you negotiate and structure the deal. So these are really amazing tips that are going to be hugely beneficial if you are in the market looking to purchase a home. So make sure you tune in Tuesdays, 7 p.m. every Tuesday. You'll be live with me. Catch the recordings if you can't make it. That's what I have for you. Thank you for taking the time to tune in. Hit that subscribe button, give it a thumbs up, and we'll see you in the next episode. Take care.